Welcome to this explainer. I am thrilled to be here with you today because, as an economist, I get to unpack one of the most fascinating data-driven stories happening right now. We're looking at India's remarkable economic resilience amidst some historically intense global headwinds. The macroeconomic data points to a very deliberate strategy at play here, and we are going to break down exactly how it works.
So here's the core economic mystery we're tackling today. Why on earth is India accelerating while the rest of the global economy is, well, hitting the brakes hard? We're going to look strictly at the macroeconomic numbers today to understand what's driving this massive divergence in growth and how very deliberate policy choices are shaping these outcomes on a global scale. To decode this, we'll use a zoom-in, zoom-out approach. First, navigating global economic storms. Second, India's macroeconomic resilience. Third, winning the China Plus One shift. And finally, sustaining future economic growth. Let's jump right in. All right, Section 1, Navigating Global Economic Storms. We all know the global environment right now is incredibly challenging. According to the ASSOCHAM Global Economic Outlook from May 2026, shipping lines and global supply chains are absolutely bearing the brunt of current international pressures. These logistical bottlenecks are fundamentally altering how goods move across borders, and naturally, that's driving up costs everywhere. The data from both the IMF and ASSOCHAM is crystal clear. We're navigating a perfect storm of overlapping crises. You've got geopolitical tensions in West Asia, surging energy prices, severe supply chain gridlock, and this constant looming threat of tariff escalations. Combine all of that, and what do you get? Tighter financial conditions, restricted capital flows, and a global investor sentiment that is, frankly, incredibly cautious as the cost of doing business spikes worldwide. That brings us to Section 2, India's macroeconomic resilience. Let's zoom in and see how the country is anchoring itself against these exact same external shocks.
The divergence in trajectory is just staggering when you look at the projections. The IMF forecasts global growth limping along at a mere 3.1% for 2026. But India? Both the IMF and the Reserve Bank of India are projecting a surge of anywhere from 6.4 to 6.9%. That's a massive growth gap, and it demands a closer look at the underlying domestic drivers.
To really understand why this is happening, wrap your head around this massive figure, 2.47 lakh crore rupees. That was a record-breaking goods and services tax collection in April 2026. High tax revenues like this prove that robust domestic consumer demand is acting like a giant economic shock absorber. It's shielding the Indian economy from those global headwinds, ensuring trade just keeps humming along even when international markets stall. And then you have the country's ultimate emergency savings account. As of April 2026, India's foreign exchange reserves were sitting at a mind-boggling $698 billion. To put that into perspective, this provides a massive buffer. It ensures the country can easily pay for essential imports like crude oil and electronics and maintain strong liquidity even if global markets panic or foreign investment takes a temporary dive. Breaking that down a bit further, it's the sheer volume of foreign currency assets driving the stability. This deep pool of reserves acts as a direct support mechanism for the Indian rupee. So external currency shocks and market sell-offs don't easily destabilize domestic pricing. It's literally built to absorb the wild swings we so often see in global currency exchanges. Here's another incredibly vital metric: non-food bank credit, which represents loans going directly to core businesses and everyday consumers, grew by a whopping 15.9% year over year. As economists, this tells us everything we need to know. Businesses are not hoarding cash out of fear. No way. They're actively borrowing, investing in infrastructure, and expanding operations despite all the global anxiety. The big takeaway here is that India didn't just get lucky. It entered this volatile period with an intensely strong foundation already locked in place. Everyday consumer price inflation, CPI, was stabilized at 3.4%. Banks had super healthy capital buffers, and the government was pushing strong infrastructure spending. Basically, this economy was heavily fortified well before the storm even hit. Okay, move into Section 3, winning the China Plus One shift. Let's look at how these strong fundamentals are letting India capitalize on the biggest supply chain rewiring of our generation. First, let's make sure we're on the same page about what China Plus One actually means. It is absolutely not a total exit from China. Instead, it's a very deliberate strategic diversification. Think of it as a portfolio approach.
Multinational manufacturers retain their Chinese capacity but build a parallel manufacturing footprint elsewhere to hedge risk. This is often driven by friendshoring, moving operations to geopolitically aligned nations.
When these massive companies look for new destinations, the competitive landscape is fierce. Sure, Mexico offers immediate proximity to the US, Vietnam has beautifully established electronics exports, and Thailand has deep EV supply chains. But India? India presents a truly unique dual advantage. You get a massive, untapped domestic consumer market paired with an exceptionally deep pool of highly trained engineering talent.
What's fascinating is that the strategy isn't to just win everything everywhere. That never works. Instead, India is capturing massive market share in specific, highly strategic sectors. The focus is aimed squarely at pharmaceuticals, electronics assembly, auto components, specialty chemicals, and clean tech. By narrowing the focus, capital and resources are deployed so much more efficiently. And this number right here is the true catalyst driving it all. Through production-linked incentive, or PLI schemes, India has engineered a policy framework with the potential to attract over $520 billion into those exact targeted sectors over the coming years. Essentially, the government offers direct financial rewards to companies for hitting specific domestic manufacturing targets. It's a total game changer. But these structured incentives go way beyond just boosting factory output. According to data from Nivishaya, these schemes are projected to generate more than 6 million direct and indirect jobs by 2025. That is a fundamental reshaping of the local labor market. We're talking about moving millions of workers into higher-skilled manufacturing roles and dramatically leveling up domestic capabilities across the board. Finally, let's zoom back out for Section 4, Sustaining Future Economic Growth. Let's see what policies ensure this isn't just a temporary boom. To figure out the long-term outlook, we have to look at the structural reforms being implemented to fix historical bottlenecks. We're seeing massive leaps in logistics connectivity, backed by over $1 trillion in infrastructure upgrades. Add to that a ruthless slashing of bureaucratic red tape, which actually propelled India's ease of doing business rank from 142 all the way up to 63, and you can see how policymakers are pouring a permanent runway for foreign direct investment. There's a quote from the Niveshai report that hits the nail right on the head. It states, India's well-planned policies and growth-driven initiatives are slowly but surely putting the country as a strong alternative to China. India is aggressively transitioning from being just a tactical, temporary backup plan into a deeply embedded strategic capability within global value chains, one that multinationals can rely on for decades. So what's the ultimate takeaway for us today? It's that economic resilience on this massive scale doesn't happen by accident. It is meticulously engineered. By maintaining strict fiscal discipline while aggressively pushing targeted industrial policies like PLIs, India has successfully built a unique macroeconomic shield. It's weathering global storms while simultaneously capturing generational shifts in supply chains. I want to leave you with a provocative thought to chew on as we watch global markets evolve in the coming years. As supply chains permanently rewire themselves around the world, are we actually looking at the new anchor of the global economy? Think about it. Thank you so much for joining me on this explainer. I really hope this deep dive into the data helped clarify exactly what is playing out in the global markets today.